We're seeing late cycle fatigue. You're seeing growth decelerating in Europe in all the major economies.
We're the last one, and now we're decelerating.
And now we're decelerating. You're seeing.
You sure?
Well, you know, no, you can't say ever that you're totally sure. But we're seeing some of the interest rate sensitive sectors like auto and housing showing some signs of peaking. And here we are. You know, how does the Fed incorporate that? And the thing that I worry about a little bit is the tightening of financial conditions. So the fall in equity prices, the higher volatility, wider credit spreads, stronger dollar, higher short-term rates, of course. So all of these things are sort of saying, hey, financial conditions are tightening. If you're the Fed, you've got to take that on board into your forecast.
So cut to the chase. Should they not hike in December?
They will hike in December.
Should they not?
I think that they should, because they've promised it. The economy, you know, there's enough strength. Yeah, do it, but it's going to be a dovish tightening, right? You tighten and then you say, basically, we're done for now, or we're going to take a wait and see attitude. And so the market's expectations, which you were pointing out before, I mean, they kind of get validated.
You don't know what Jim's going to say, do you?
Well, Jim's going to tell me that I'm wrong, so
no,
I can't wait.
He's not. No, he's not. He's going to say, for most of 2018, we were looking through problems at the peak, looking towards the peak. Now we've seen the peak. Now we're looking through things at the trough. So you're basically, you've turned from a half full guy to a half empty guy.
Yeah, I think so. Well, I mean, you have to follow the numbers, right? So, you know, full growth for 2018 is probably going to be above 3%. 4Q over 4Q, 19 over 18 is probably going to go down to 1.7%. That's a Morgan Stanley forecast. So it's about half. So it's significant deceleration. When you're looking towards the peak and things are good and your earnings are growing and you've got GDP growth, then, you know, rising rates and U.S.-China tensions don't matter as much. When you're looking towards the trough, that's the background noise. That background noise moves to the foreground. And now suddenly we've got to contend with, you know, with taking a look at that. And I think the markets, well, in particular, I think the Fed has to really incorporate that into their financial conditions as we were discussing earlier. So it would argue to me that they probably they err on the slower side. So maybe it's 2 hikes next year. The market's pricing 1. I think that's a real probability.
You think they're in a position of managing some type of landing here, and it's like a mattress.
Right.
You think it's going to be soft, bumpy, or hard? Right.
So I think the Fed does have a role to play, right? So, you know, as an oversimplified rule of thumb, I would say if the terminal Fed funds rate is 3% or less, we get a soft landing. Between 3 and 3.5, it becomes a bumpier landing as recession risks could rise. If we move above the 3.5% territory for terminal Fed funds, then I think it's a harder landing. So I do think that the Fed is going to try to manage or engineer a softer landing in this cycle. And I think that's the key takeaway, which means that there might be a silver lining around asset prices at some point if it gets communicated that the Fed may not go as fast as
What happened to all the hawks? What happened to all the guys that were like, the Fed is too low, you're creating excesses in the economy? All of a sudden, everybody who was out there screaming that the Fed was too low is out there screaming that the economy can't withstand a 2% Fed funds rate, or really, to think about it the way Dino might, a 0% real rate, right? The economy is so weak. No, I know, Jamie, but I'm saying in general, the economy is so weak, Dino, that we can only withstand a 0% real funds rate.
No, it's debt so high that the rates are different now. They go up a little when we owe so much.
No, that's a great point. You know, you know, we have had an expansion of debt in U.S. and globally.
Your fault for staying at 0.
So a real rate after having a decade of negative real rates.
The Roach Motel that you got.
I didn't pass $1.5 trillion unfunded tax cut.
Yeah, no, you only passed $11 trillion for cash for clunkers. Anyway.
Anyway, the point that I was making was, you know, even a mildly positive Fed funds rate, real Fed funds rate, you know, is showing up, and so you're seeing the interest rate sensitive sectors already responding. I mean, that tells you that the economy, the underlying economy, is not as powerful as the 4% number.
But of course, the interest rate sensitive sectors are going to respond. It's the only way for the Fed to have any effect on the economy is to push down, and the ones that feel it most. Are they blinking here at a time where they should be staring? I don't know.
Maybe. Let me just raise the point we were talking about before a little while ago, which is that next year the Fed's balance sheet is going to contract by quite a bit. So, you know, that is
$600 billion.
$600 billion of redemptions that will be coming through. That's an amount that the market needs to absorb. And so that's another way that the Fed can tighten financial conditions without moving the rate. And we have to keep that in mind as well.
Jim, Is the bond market now priced for your soft landing? You think it's accounted for the fact that there's going to be this maybe prolonged pause in the first half of next year? In terms of the Fed
I think we have to look at every asset, very specifically. So I would say that the Treasury market, Treasury yields have come down probably towards, I'm going to put the lower end of the range if I can be very unbrave and say that we're in a 250 to 350 10-year yield range. So we are towards the lower end of that right now. And I think the bond markets are way ahead of this, pricing in maybe one hike for next year. Other asset prices, though, I think they are probably going to, probably have some more trouble. But I do think that relative to the economic fundamentals that are currently in the markets and are expected to be in the markets over the next several months and even quarters, asset prices may have fallen a little too much relative to the fundamentals. If those fundamentals don't deliver, then those asset prices are right. But I think that there is some upside surprise potential that could be in here, too.
Which would include stocks, presumably.
Yeah. Oh, yeah. Yes, absolutely.